really top of mind. Thank you, Emily. So funding is on top of mind of so many of these companies, maybe especially in this cohort. So I think that we have 2.5 hours. We usually do this in 3 hours. So now we have 2.5. Lots of content for you. Arne is, as you have discovered, one of the most knowledgeable people in the industry for all kinds of, so any question you will have, I think, if we had some time for Q&A, Arne, that would be great too. But, we are very lucky to have you as our part of our TINC core team, and contributors make such a difference. So I know you have so much to do. Appreciate you coming back. And I'm going to give it back to you. And thanks so much again, Arne, for devoting your time to us.
Of course. And good to be back. And hello to all of the people I know, and hello to the few that I don't. So, yeah, good to be back. So, I mean, I've done a funding and... Sorry?
Well, did someone say something? I think it was just...
Okay.
Yeah.
Just that's one of the things I'm going to say. Interrupt me at any point, because I want to make this interactive. So so that works. And I think I've done, I don't know how many now, also funding and fundraising workshops for TINC, but it's a bunch of them. And I think also will be shocked, because it's been sort of a formula I've been going with, and then as the market has developed, and I think probably I have developed, and the feedback is sort of the questions. It's sort of, I've evolved it, and then it's just gotten bigger and bigger and bigger, and in the end we were struggling to make it through in 3 hours, primarily because also people were engaging and discussing. But anyway, I've cut it down, so also will be surprised, which means that hopefully we can stay well within the time limit, and also have then time for a bunch of discussion. But at least hopefully I've cut the right things and not the wrong things. But we'll figure it out today. As I said, I'd like to make it as interactive as possible. And what I tend to do is also to start with sort of a whiteboard and say, like, what's your sort of key issues when it comes to funding and fundraising that you'd like to cover here today. So I'll share a whiteboard, and let's see if that comes up. And we can just put up some questions and topics that you want to make sure that we cover.
You want him in the chat, Arne, or do you want him?
Well, I'll just, we can do it either in the chat, or we can just get some things up here, but I think we should do it like a short joint session on it to make sure that we get something up here. Yeah.
I'm actually curious, like what not to do when meeting. I think although the session so far I've learned kind of a lot about, we've learned a lot about the mindset. So it would be interesting to understand like what not to do when it comes to, because there is a difference between European and US investors.
Yeah. That's actually that's a question I haven't gotten before. So this is a challenge, and I'll try to rise to the occasion for that one.
Yeah, I also heard, like speaking with one VC actually, kind of like last week, that if you want to raise in the US, you kind of need to say like you're raising now, and not kind of like we're planning to raise, because then you're becoming kind of like not sexy. So I just want to maybe have some better understanding of kind of like, when are you kind of communicating your raising, and how is the typical process looking like? Like you should go kind of like straight to the chase, and follow-up meetings, and due diligence, and closing, kind of like, is that kind of like a framework that is more, kind of like a framework in the US compared to here? Because previous experience more like it can be long, it can be short, depending on different factors, but maybe it's more of a framework there.
Yeah.
Maybe to follow on that, exactly. I think my question is like, once you have the traction, once you have, the pitch deck and the data room, how to run the process in the most efficient way, how to close in the fastest way possible. Like, how do you sequence things? How do you generate momentum? How do you generate FOMO? How do you play each VC against each other? Like, I would love to deep dive on the most efficient ways or levers to close the funding round once you open it.
I'm not sure how to word it, Arne, but I'm thinking, at least for us specifically, would be like timing and signals for when it's the right time. So us specifically, like we feel like maybe the next 10 months it's actually not VC, but maybe it is. So just like anything around this, like timing and signals that you're ready for it, for example. Fundraising, of course, we want to do, but it's more of like VC or not, and is it the right time right now? This kind of question.
Mm. Mm.
Yeah, I think I'd add the same to what Scott said. We're a corporate spin-out rather than a pure startup, so that kind of corporate venture journey versus traditional VC funding journey is super interesting to us. But also kind of basic cap table understanding their first time going into a fundraise is super interesting. And then the last thing would be what's the dream process from a VC's point of view? Like, what do you love? When you look back and say that was a really good process, what does that look like? So.
Yeah, and maybe also the due diligence process, typically on a seed stage, what to expect and how to prepare for it in a professional manner. And also maybe like a more of a unique question, because I heard from someone that given that it's a presidential year, it might not be, maybe the last time of the year to raise fund in the US is kind of like Q2, because when it's a presidential election, like everything stops in uncertainty. And I was new to me at least, but if you got some experience with that, that would be interesting as well, because it goes back to now or the process kind of question I had initially.
Yeah. Okay. Let's see then. Let's see if I can spell. Yeah, I think I'll try to answer that one, but that's also a first time question for me, and I don't know if I know the. I have a theory.
New to me yesterday as well, but
yeah, I'll be happy to speculate on that, but I don't think I know the answer to it. So
it was a mentor of the program that told us that, so that's all. I guess it's come from someone competent.
Okay, good. All right, we're running out of space on the whiteboard, but I'll do one or two more if there is something you think is important, and otherwise we'll just deal with it as we go along.
I have one. Specifically, we're gonna raise, our next round is gonna be like a seed round, and just your thoughts on important milestones. Like, what is usually needed to be achieved in order to raise a seed round? We've heard anything from, unpaid pilots or unpaid tests to X amount of 100K in ARR. And specifically, we're kind of a deep tech, so long iteration cycles might be different from more of an app, let's say. So just a bit around that.
Okay. Yeah. Good. All right. Let's get going, and I'll try to cover some of these in whatever the slides that I've prepared here, and then we'll check in. Hopefully now we don't run out of time, and then I'll try to cover whatever I haven't covered along the way at that end. But that shouldn't stop you from like interrupting me on the way. And I think discussion along the way is actually TINC groups tend to be really good at that. So I really like that because it makes it more interesting for everyone. A few things else is that this is sort of very VC oriented in the way to think about this funding and fundraising. Of course, VC is not the only way, but it's the way that I know reasonably well, and that's the focus here. But I think like if it's earlier and it's angels, or it's sort of more industrial investors, or sometimes you get funded by soft funding or something. There's a myriad of ways of getting a company funded, and so I just want to be clear on that. It's not necessarily the only way to get the company funded. I'm just not an expert as much in the other ways. The other thing is that it's a balance in the sense that you have to look at they're having an important customer meeting. I think that is the most brilliant priority ever, because customers are always more important than investors, because customers give your company growth and internal life if you have enough of them. Investors buys you time. So if you can choose between people buying your product and sending invoices and so forth versus selling shares, always send invoices. So I think that's also worthwhile, is keeping in the back of the mind, even if I understand that also hopefully what I do and my colleagues do is important, and it's also an important tool to build great companies. This is I think a worthwhile thing to remember. Okay, let me know do you see like the full screen or my note screen now, or neither of them?
Full screen.
Full screen.
Yeah, looks good.
Okay, so we're in presentation mode. Good, and then I'll try to make it work so I can actually see you as well. 1 second. Okay, and that works. Yeah, so essentially we have sort of a self-evaluation exercise in the middle, but essentially the agenda is kind of like two things. What do VCs look for? We're essentially trying to transfer how do we think, so trying to open my brain up and show how we think, and then hopefully that translates into, by you understanding how I or similar people to me think, that makes it easier for you to sort of hit that in terms of being fundable. And the second one is like more process. So while the first is how do we think, the second is how do we work, and how does that align with how you need to work to raise money. And then the Q&A or the discussion is like open mic, and also covering whatever we have on the whiteboard that we didn't manage to cover on the way. I should also say that like I sort of share how I look at it, and there are some things that I think like almost 100% of venture capitalists agree on, and is sort of common knowledge, and I think it's pretty predictable. But there are also things where I might have a opinion. If you ask a different investor, they might have an entirely different opinion. So I think like on average, you can assume that 80% of what I say is probably right, and 20% of it is probably doesn't fit. Or at least, so for example, the process question that we had on the whiteboard. Some venture capitalists like to only have meetings where like there's a process, and some like to build relationships. And you don't know necessarily beforehand who's who. And so that just is an inherent challenge that, you can have opinions about how it works, but there's no like one right answer to it, to be honest. But we can talk more about that specifically. So I think we'll go into sort of what do we look for, or how do we think side of things first. And I think I like to think about it sort of like as venture capitalists peeling the onion. How do we work from like on the surface of it, and each layer in, what's the impact of that? And now I have probably 2 or 3 layers more of the onion than I had last time also. So hopefully we have enough coverage on it. But like there's some fundamentals about what we do that has impacts on how we work. And so venture capitalists, unlike angels or some other things, our job is to manage money, and we structure as funds. So that means somebody pays us for deploying capital. And by being professional money managers, we have to have very clear responsibilities to the people who give us money. So some of these might be obvious, but in venture language, the people who manage the money, such people as me and my colleagues, are GPs, general partners. And we're responsible for managing the money, but it's some of our own money, but mainly other people's money. And these people are the LPs, the people who give us money. And the GP is, in US terms, a fiduciary. So that means we have very clear obligations. And, that's both, in terms of what kind of risks we're taking, what we're allowed to do. And an important thing is our objective is to make returns of those money. We cannot choose to invest in something because it looks cool or we like it or something like that. It has to be because we think this is the best deployment of money in terms of making our LPs money. And that means that also financial returns is the main goal. You can have other goals, but as a VC, those don't rise above making money. They could be on par, is in like solving the environment or whatever is a good objective. But if you're a true VC, that cannot go beyond the making money objective. So I think that's sort of is important to bear in mind. Venture capital is a form of private equity, and private equity essentially means it's investing into companies that are not listed on stock exchanges, which is public equities. But that bucket of private equity has a number of types of funds. So, for example, buyout funds, and buyout funds take over your company and run companies. These are typically larger companies. Venture capitalists are minority investors. So that means that if we end up with a majority share, something has been fundamentally wrong on the way. And the fact that we aim for minority investments means that sort of the risk, we are betting on the founders and the management of the team to make us money. So sort of some founders are afraid that venture capitalists will take over and run their company. If that's the scenario, that's something has gone wrong, essentially. So that's an overstated risk. There is a risk that, you know, something goes wrong down the road and, you know, people are fundamentally unhappy with how you run the company. And then as being a GP or a fiduciary, our obligation is to look after our money and we have to change management or something like that. But generally in the early stages of venture capital, the way the portfolio, if it doesn't work, you just say, well, this money is lost and you move on. So the risk of like a venture capitalist, at least in the seed A stages, wanting to take over and run your company is just very overblown because the nature of what you do. Because the nature of that is also making the company unfundable for the next round, because venture capitalists typically at all stages, at least till you get to the B or C stages, bet on founders. So it's in our very strong incentive to make you successful. And I think that is something to understand. And that tends to be very different from a different kind of investor. So say there was a question of CVC or like corporations in investing. They typically have not just making money objectives. They also maybe have strategic objectives. And if you have to take over a company and make it a business unit, so be it. That might be really good. That's terrible for venture capitalists. And I think that is useful to understand. We tend to make money when we sell shares of the companies, and selling shares of companies tend to be good outcomes if typically the company is listed on a stock exchange, which tends to be rarer and rarer these days, but then you can sell, you know, your shares in a listed company, or it tends to happen when a company is sold. So either sold to an industrial buyer or a private equity firm or something like that. Any other outcome tends to be suboptimal, and therefore we don't live off dividends or anything like that. It's typically exits that make us money, and that means that even if this is not really talked about, I think you should understand that the implicit agreement by taking venture capital is that your company is up for sale at some time in the future. And so I think it's better that all parties around the table know that, rather than like 3 years down the line was, you know, we're not on the same team, and you know, your objective was to run a company till you're, you know, ready for your pension or something like that. Then that's a misalignment that is better to know before you take somebody's money than afterwards. And also venture capital funds typically run 10 years plus some extension period, which typically altogether is 12 years. So that's also sets the time frame from kind of the time period when your company is kind of up for sale de facto, which is useful to so kind of understanding a venture capital firm. When was your fund established and how long does it have to run from here is actually an important factor for a founder or a startup to know. These are sort of the frames that we have to work within. I see there's something in the chat here. Okay.
I think those are old questions.
Okay. Yeah. Catch me later if I haven't answered the questions, I guess. And also, if you think it's appropriate during discussions, just raise your hand, and then I'll stop talking as well. Okay. So in terms of the financial industry, venture capital is about the most risky thing you can do. Possibly investing in movies or music or something like that is more risky, but compared to most financial assets, it's a very, very risky business. And then at the same time, it's so much less risky than being a founder. And so kudos to you, to all of you who want to be founders, because that is really living on the edge. We think we are, risky individuals, and yet we have a portfolio to hide behind. And if you look at US VC, I love this data set from Correlation Ventures. They have looked at, I think this is a slightly old version. There's about 28,000 venture investments in this data set. I think they're now up to 32,000 or something like that. But you look at the distribution on what's the multiple invested capital. And when it's less than 1x, that means you lose money. And that is actually 64% of investments in the US and 51% of the capital. And then if you look at like what makes more than 10x the money, it's about 5% of investments, or about 4% of the capital. So inherently, this is very difficult to make money on an individual investment basis. And of course, what then happens is it's kind of like a valuable risk to take, simply because the worst that you can do is lose your money, whereas the best you can do is maybe 100 times your money. And it's about the probability of the two outcomes that essentially makes it worth the bet, right? But this distribution of outcomes, which I believe there's no equivalent data set in the Nordics or Europe or something like that. I think my gut feel after having been in the industry for a long time is that the shape is the same. There's possibly slightly fewer failures, simply because it's easier to stay alive on soft fundings and these sort of things. Hello, Frode.
I'm sorry. I can't control. I'm driving at the same time here.
That's okay. Maybe there's a mute or something.
Yeah.
I muted you,
Okay.
Frode, sorry.
Okay. Yeah. So my gut feel is that the distribution in Europe and the Nordics is the same, probably marginally lower failure rates, but still very high, and probably even fewer of the really, really big outliers of 100x or something like that, simply because the markets are smaller and so forth. But I think for all practical purposes, we have to assume that in all markets, this distribution is the same. And given that we are dealing with distribution and statistics, as an investor, you simply have to live by these by the statistics, and that leads to what I call the law of gravity for venture capital. You have this power law distribution of outcomes, which is different than other. So if you look at other financial assets like listed companies or currency or real estate or something like that, the distribution is sort of more normal shaped. and most financially minded people are used to thinking of risk and outcomes in a normal shape, and just adjusting your head to a power law distribution is just really hard. But that's what venture capital does, and experienced, or at least smart or experienced venture capitalists understand this distribution. Those who don't are going to lose money. But the more that you understand that, also the more your pattern of behavior is driven by this distribution. And if you take the distribution on the last page and you start translating that into fund returns, it turns out that your fund return is more or less decorrelated with your failures. So whether you lose 30% of your portfolio or 60% of the portfolio, or even up to 70 or 80% of the portfolio, it makes very little impact on your fund returns. But your fund returns are highly correlated to the outliers, to the 10x's, the 20x's, and the 100x's. So ultimately, understanding that, what you do when you understand that profile of outcomes is that you get more and more focused on living with big risk, but only at the evaluation that the outcomes has to be really, really big. So this is the thing that drives investment behavior more than anything. And that's also super important to founders to understand that that's what drives behavior. And this gets to be more and more extreme. So I'll do the quick math here for you. So say you have a fund of 100 million, whatever currency we're talking, and you invest in 30 companies. In essence, you have to think of, let's say 3 of the companies contribute. So 10% of your portfolio contributes to the outcomes. So think of it as 3 positive outcomes and 27 losses. This is an oversimplification, but the actual contribution it's more distributed. But in reality, if you take your 3 biggest outcomes, it's more than 90% of your return. And as a venture capitalist, you're measured on tripling your money per fund. That's kind of like the gold standard. Most funds don't achieve that, but that's sort of your gold standard. So that's what you're aiming for, tripling your money. So if you lose money on 27 companies, but you make money on 3, and you have to triple your fund, that means each of your investments need to return your fund. And if you're a minority investor and like a good scenario, you own 10% of the company. So if you have $100 million fund and a 10% ownership needs to return your fund, that's $1 billion company you need to build. And that's kind of the logic behind the unicorn hunt, right? And the bigger your fund, the worse your chances, and the bigger the outcomes are, right? And so we're in a world where, like in the US, the funds get bigger and bigger. That means that like a unicorn isn't good enough. Unless it's a decacorn, it's not meaningful anymore if you have those big US funds. And that's why, you know, we've been in sort of a continuous feedback loop over the last 10, 15 years, where investors are more and more selective and they're going for bigger and bigger bets to make this sort of prophecy of outcomes come through. It's slightly easier to be like a small Norwegian investor, simply because we're, you know, $100 million outcome is actually meaningful for us. If we own enough of the company, it doesn't have to be a unicorn. But you know, given that you're going to meet US VCs, understanding this sort of self-fulfilling prophecy to go for home runs is like super important to understand. So that's sort of like, I think the most important sort of super high level what drives mindset and behavior and what you look for in the companies you're looking to invest in. So what does that translate? Yeah.
Sorry, I have a question. Sorry if it's loud. I'm biking, but I also wrote it in the chat if you want to double check. But I'm curious because there's so many companies that are maybe when you think about it, are very unlikely to be a billion-dollar company or unicorn company that seem to be very successful with VCs and very popular with VCs and get a lot of hype and so on and so on and get a lot of funding, even though there's very limited chance they become a billion, unicorn dollar startup. How do those companies then get VC money if it's all about the 10x returns and returning your fund with that 1 or 3 companies, like you say? Like, how I think the majority of startups, I mean, I don't know, like, do you see my point? Like, how do those companies then get the funding or crack the code, or how do they do it?
Yeah, I think the answer to that is somewhat complex. I think there is a difference between the US and Europe in more than one way. I think if you have a small European fund that's like below €100 million or $100 million, you don't have to have unicorns to make to be meaningful outcomes. So that's part of the answer. But if you take like a US context on it, it's surprising because of the size of the market. It's surprising how narrow a company can become very, very big because of the size of the market. So I think you will be surprised if you sort of frame it the right way, how big things can look when you take like a US perspective on it. And the other thing is that there are some element to buying into a path, but you have to tell a very compelling story, right? This is our beachhead market, and then if we do this will either the market will be much bigger in the future, or we can achieve, we start with a veg and then we become bigger. But that is a very tough narrative to sell in. But if you take the flip side of that, right? When people invested in Facebook, it was a non-existing market and had 0 in revenue. It's still a $1 trillion company today. So people sort of, if you have like the right projection of what it can become, then you can answer that question. But it's not a simple, I don't think there's a simple answer to it. And then to be fair, venture capitalists more than half of the time do stupid bets as well. That's part of the explanation as well. Yeah. So sort of how do we translate this looking for big things? I think that the other thing to be aware of is that say we follow this simple framework of like needs to be a unicorn. The other thing is that if you do early stage investing, you invest in companies with 0 revenue or very close to 0 or very little revenue. And the way to get to a unicorn is typically you have to have $100 million of revenue at least. If it's recurring revenue, then you can say, the company value, if it's growing fast enough, is probably 10 times the revenue, recurring revenue. But that still means going from 0 to $100 million in less than 10 years, given the length of the fund. So not only does it have to become big, it has to become big very fast. So that sort of translates into this thing about looking for things that are very scalable or high growth of some sort. And so then when we look at the big and fast way of thinking about it, what does that translate into that people look for? VCs look for some formula of X% team or founders, Y% TAM, and TAM is like how big is the opportunity, the market we're going after, and therefore sort of a proxy of the opportunity we're going after, and Z traction, which is essentially some sort of measure of speed, a proxy for how fast can it grow or how can it scale. And some venture investors are very sort of, particularly the early stages, like they are very sort of founder oriented. Is this the founder who can like build this amazing thing, the next unicorn or whatever, decacorn? and are more or less only oriented towards founders, particularly at pre-seed. And so that would typically, okay, we pile in money at the pre-seed company, but these guys have built 2 companies before, or these girls, or whatever. Unfortunately, not too often girls, but we hope that improves over time. Or they have proven that they built this product within Google, therefore we believe they can build this company. That kind of like founder, or like great deep insights into the specific problem. This person just understands this problem much better than anyone else, right? That's like the founder problem fit, or founder solution fit. So that's kind of like that. The TAM or the opportunity, I think, is like self-explanatory what that is, and traction to some extent. And some people say they're, we're founder driven, or we're opportunity driven, or we're metrics oriented, which is another way of saying traction. Sort of people tend to hang their hat on one of them, but in reality, I think it's always a percentage of each if you take the tabloid version of what you're looking for. So TTT, team, TAM, traction. Another way of framing that is people, product, potential, where people and team is essentially, kind of same dimension. Potential is very TAM-like in nature, and product translates into traction if it's good enough, right? It solves problems, then customers will tear it off the shelf. And then some that are sort of more impact oriented or something will sometimes put a planet on here, right? Not only do we think like the fundamental business properties are in place, but it's good for something. And you tend to frame it in some sort of T or P framework to just make it easier to remember or catchy to explain what you're looking for. And I think all VCs look for like big outcomes fast. They also sort of have a framework of thinking about what does that mean in terms of the qualities we look for in a startup, or So I think that's these are sort of pretty common ways of thinking about it. So I put up here what we sort of use as our advanced TTT or PPP framework. The way that we think about it, now I'm talking about like Alliance as an example of a VC. We think of it as sort of a foundational layer where there's like an exceptional founding team, and we believe that has to be in place because these journeys are always not like what they look like in the plan, and therefore to be able to navigate that and iterate and perform it requires skills. So even if the plan or the potential looks great, you have to have that in place to be able to navigate it. And then we tend to look at it in sort of a bottom up and top down fashion. So the bottom up is kind of, are there indicators that the company is on the way? It's in a way a traction dimension, but it's sort of a more sort of fuller description of is this pointing in the right direction? So that's typically sort of indicators from customers or sales. Do we think the product is more like painkiller than a vitamin? Do the company really understand what they're trying to do? Do really smart people want to join the team? And these sort of indicators that like this is really going the way, and that's like our way of thinking. So we like to see some bottom-up indication that this is going in the right way. At the same time, like to hit a venture-sized outcomes, we tend to think, is the TAM big enough naturally? But not only that. So the way that a company gets really big is by performing 1 year, building on that and performing better the next year, and some sort of accumulating growth curve. Because you don't go from 0 to $100 million in a year. It tends to be like 0 to 1, and then ideally 1 to 3, and then 3 to 9 or something like that, and eventually you get to 100. But that only works if it's sort of you you can benefit from whatever you do at all times, and the revenues accumulate. But it also happens only when you're aligned with long-term trends. So if you're solving a problem for a customer, but next year, this or 2 years down the line, the trends in the market are going to change because new technology or whatever regulatory framework or whatnot changes the world, then you will not get accumulated effect, and sort of your journey will be short-circuited. So we try to think, is it aligned with these long trends, or will it be washed out by whatever happens next? Yeah, and also other like network effects or other things that sort of protects. If it's too simple and there are no like network effects or other moats, you know, is it too easy to copy and somebody will come and take it over? So I guess we're subscribers to a TTT framework from a tabloid perspective, but we try to think more deeply about it, and maybe not in as simple dimension as just TTT. And I think to be honest, this is not like a rocket science or unique, and I just think that each firm probably has a different strategy in what kind of companies they invested, and they also then have like a way of thinking about it that's deeper than like a TTT or a PPP framework, even if that's what they present outwards. But then assuming, let's say, okay, we were bought into, this is a great company, we believe in the mission and the potential and the journey and the team and all that. You get into some sort of, okay, but does it make sense from a purely investment perspective? And then you get into a sort of, okay, does it make, what makes sense to invest in, and what, like, can we meet the founders on valuation? And I guess investment size sort of is very closely related to sort of your fund and your fund size and how big your portfolio is. Does it fit the bracket of the money that we do for individual investments? But there's also the valuation, right? And I think sort of engineering oriented founders tend to ask me, what's the evaluation formula? And that's clearly way too sophisticated and doesn't actually replicate what goes on in the market. I think the reality is that valuation is a triangulation and negotiation effect. But you can always do exercises to help inform, is it worth negotiating and does it make sense? And I think those are based on internal factors of a startup. You can do calculations. There's something called the venture capital method, which is, you know, there are formulas and sheets out for, which essentially is driven by like a future exit scenario and then how many funding rounds are on the way, and you can do that. Traditional ways to look at cash flows, which typically breaks down for startups, but some people still try. You can look at, are there hard assets that you can value? What was the valuation of last round? These sorts of things informs you about what is sort of a window for valuation. The other way to look at it is kind of like external factors with what do founders believe they're worth? Can you do market, you know, multiples of revenue or something like that for based on what you see elsewhere in the market? Are there other investors who are willing to fund, and what they invested, what are they valuing it at? And next round, I think, is a very useful thing to look at. So I think all of these things helps sort of frame a discussion around valuation and an evaluation for us, whether it makes sense. But in reality, it comes down to, is there a window where everybody's reasonably happy and it makes sense? And so I think it's very practical, and I think it's about, you have to price high enough. If you're keen to invest, you have to price high enough so you win the deal. That's like if somebody else bids higher, then you're out, unless you have some sort of case that you add so much more value that founders will take a lower price. But it's generally not a good discussion to end up in. The other is you need to price high enough to avoid a dilution of the cap table so that it becomes unfundable in the next round. And it has to be low enough so you think the next round will be at least twice the price of what you're paying now. So I think that's also a very valuable. So oftentimes what we look at is kind of, if you look at the trajectory and the traction of the company, you think of an investment. How, you know, if we invest this amount that the founders look for, how long is your runway? It should be minimum 12 months, ideally 18 or 24 months, and what can be plausibly achieved at that point? What sort of milestones can you reach within the runway of the cash? And then you sort of work back and say, okay, if we believe these milestones, we buy into them and maybe discount whatever the founders think of those milestones, can the company raise money at a significant up round then? That's like a litmus test of, does it make sense to invest? And secondarily, if these milestones, what do we think the market will price it at then? And then work back to say, well, half of that, does that hit that window of non-dilution and winning the deal kind of thing? So I think that's also a useful kind of framework to work from there in terms of valuation and so forth. I think there was a question around a seed round. What needs to be in place for a seed round? This is also one of these, I would say, very complex questions that you would think is very simple, but they're not. It has to do a lot with the TTT framework. So if you have lots of traction in the sense that it looks like you're growing really fast and the customers love your product, then you maybe need less absolute revenue or whatever. Or if the potential is just so amazing and what you're doing is so unique that there's very little market risk, then you might not need to have the product in the hands of anyone. People will still do a seed round for it. Or if you're like a two-time founder who's really proven, then people will throw money at you. So the reality is that it's also triangulation of these factors in the market. So I can say that of the seed rounds I've done lately, and seed rounds that I've been working on over the last year, they have been from $1 to $3 million. And they have been in companies that had, all of those had revenue, but most of them were in the $50 to $200,000 range of revenue. One had 800. But I'm also involved in a Series A now that has no revenue at Series A. But they have hundreds of thousands of people who want to use their product, and it's a stellar team who's, you know, like, amazing track record. And that's why it's so, and none of these are like deep tech companies, because the deep tech dimension as well sort of throws it up, because there should be less market risk, but it takes more money to get to revenue, right? So it's so hard to say this is the formula for you. It's much more about, okay, are we really strong on one of the T's? Then you can discount the other. So I would say, like, so if you're a deep tech company, if the potential is amazing and like there's hardly any market risk because it's so obvious that if you succeed with a tech risk, then you don't need traction. But you need to find the right ones to understand the potential, right? And that's why it's like just super hard, but try to frame it in the TTT framework and say, why are we outside the norm? And can we substantiate that we're really, really amazing on something. Otherwise, I would say a seed round of $1 to $3 million is between $50,000 and $200,000 of revenue.
Thank you for answering that.
What was the valuation of those companies, roughly speaking?
Sort of 8, it's pre-money valuation of type 8. No, actually 6 to $14 million pre-money valuation.
Thanks.
And I think these are in the high bracket for the Nordics. They're probably marginally below bracket for US.
Was it US companies or was it European?
A mix. And now I'm talking about the seed companies, not the non-revenue Series A. That's like a completely different game. Yes. And then the other thing is sort of a little bit about, you know, the mindset of investors to move, right? So there's kind of like an asymmetry between founders, investor, and sort of, do we make decisions and do we move on, right? Because founders just want to get to a decision, and like when I get the money, I can do the things that, you know, my plan says, and I can get going with building a great company, right? Investors, it's kind of a risk reward, and like if there's no urgency to actually move, then, you know, you have just less risk tomorrow. Or I can choose to deploy the money in something else. So in reality, even if I think it's bad practice, it's just also the incentive structure of actually putting money in is kind of misaligned. So I think, therefore, there's like a little bit of a thing where investors don't necessarily give straight answers. They just hang around for a little while. Where I think you should push investors to make decisions, and we should be better about it. But there is definitely this thing about let's see the next milestones or whatnot, right? And so I think there are only 3 ways of making investors actually commit money, and one is like ultimate passion, right? Maybe in your life before, you've seen this problem that needs to be solved, and it just drives you crazy that nobody solved it. And if you hit that investor who has that passion for solving what you're solving, that can make like people move. The other is like if the investor is so convinced that this is that you're brilliant and will make them money, then the greed thing can make it happen, because ultimately we're in the game to make money, and if I'm convinced that you will make me money, there's no reason to wait. Then you can make me money now, but if it's just risk reduction by waiting, then you wait, right? And the final one is FOMO, and that's definitely the most productive one in making investors move, because like say somebody else will grab this brilliant deal if I don't do it, and we are herd animals. So I think that FOMO is the one that makes things happen the fastest, to be honest. So I think that was like sharing a little bit about how we think and what we look for. I'm just going to go back and check here if there are things here. I think a lot of this is process oriented, the questions here, I think, which we'll deal with in the second section of the I think we did cover the what's needed for seed kind of question here, and I think I'm still thinking about how to answer the what not to do. I think I can partially answer that. Don't show a small market and don't show slow speed. I think that's like inverse of the TTT. 1/T, I guess it's called, but it's probably not the most brilliant answer. But I'll work on a better one till later in the presentation. Also I succeeded in speeding up slightly for the first part of it by removing a few layers of the onion.
Yes.
So now
we're at an hour. Do you want to take a short break, Arne, or?
So I think we should go to the self-evaluation
Yeah.
exercise
Perfect.
and present that, and then we'll take like a 15-minute break where you can think about that. And it's not very you can pick one or two questions and think for yourself and say and come back and present to the group, you know, what you think about that. The first one is kind of like a more positive one, and the second is a more negative one, but I think actually the second one is useful to think about now that I've sort of presented. It's kind of related to the TTT framework or the PPP framework, right? And if you look at the team or the people dimension, the why you question, because I think if you can answer that really great, then your chances of raising money is better, right? You know, why do you have the unique founder problem fit? That is something that I think can be part of your narrative. Alternative understanding, you know, the way that we look for big things that go really fast, translated into the TTT or PPP framework. What do you think your main weakness is today, and how do you then reframe your story to try to crack that nut? And so if we meet back up at well, Central European time of 7:15, and then maybe we can have 2 volunteers or something like that, and then we go on to more sort of process-oriented stuff.
Sounds good.
Sounds great. Sounds good. Thank you so much, Arne. We set a clock, so we have 13 minutes. Yeah. See you back in 13. Okay, everybody's back, I think. Do you want to have some volunteers, Arne? You're muted if you're talking.
Yes, there we go. Yes, I said absolutely. Maybe we can have one for each, unless everybody's chosen the same.
Okay, hands up. Who wants to go first? Scott.
Yeah, I go. I hope I didn't misunderstand the question, Anna, because it's like for me, the timing question that I had early on is kind of my struggle here. But at least when we're talking to VCs right now, it's that our company is deep tech, right? So it's infrastructure to hardware to then the data and services on top of it, and we get dismissed on at least where we're at right now, that we haven't probably figured out that TAM part of the 3 Ts, because we're focused on Norway. We want to do infrastructure in Norway. We want to build on that. So it's very complicated, I guess. So that's where we're dismissed. And then I think on the mitigating side, at least for me, it's again, maybe try to understand where we're at in this process, right? So I think mitigating is still talk to VCs, still understand what they're looking for, still try to do these things. And then when we are ready, hey, look what we've done. We've solved maybe some of the concerns you have with the deep tech side of our company, but now we have, you know, yeah, this thing that is repeatable, is scalable, and we're proving it. So for me, it's more of this. Yeah, just my reflections on your question.
Yeah. So if I think out loud, and now, of course, I'm, you know, going on about something where I pretend I know a whole lot that I don't about your company, right? So like with all sort of background that I might be completely off.
Yep.
But I think that if it's true, you should definitely not define Norway as your market. And get, I think the way to you know, if the type of customer and their use case is repeatable across multiple markets, if the sort of the go-to-market can be repeated across markets, I think that it's worthwhile sort of, you know, slice your ICP as something, both your ideal customer profile, ICP, and the go-to-market model as very generic, and framing whoever is, like, if you have a pilot customer or something that happens to be Norwegian, that is just a very good pilot to go after to prove the general thing, which is much bigger, right?
Makes sense. I have a lot of questions, but let's get the other ones going. And
yeah,
it's a good.
But you know, I'm happy to have like a separate.
That would be great if
conversation
great,
about the specifics, and then maybe what I said now just doesn't make sense. But it sounds like an interesting exercise to see if you can sort of mitigate it. To be fair, when we invest, oftentimes one of the key sort of if you look at the bottom up column that we have, is kind of, have you landed a non-Norwegian customer? The likelihood that we invest, if you have landed a non-Norwegian or a Swedish, if it's a Swedish company, is one of the main de-risking factors, whether you've solved a Norwegian problem or a general problem.
Yep, cool.
And therefore also mitigating the TAM issue.
Yep. And I can just give you just some feedback on that. For me, it's like we're about to get something in maybe 2 Swedish places, which is starting to get, and maybe, for example, Colorado, but it's not landed yet. But this is something like mitigating is trying to do that, at least for us, because it is a big signal, I guess. Yeah, thank you.
Yeah,
I would love to go next.
Go for it.
So I think our thing is, it's very clear why us, or at least, you know, we can argument that very heavily. I think it's the second one that, and the main thing that we get dismissed for is too early revenue. That's what we keep hearing, right? So too early, like too little monetization. So we're a little bit early in that cycle. We're about like $20K. But at the same time, we just we landed Instacart deal in the US. So instead of sitting in Sweden, we actually made a strategic decision to start expanding to the US straight away, because that's the market we want to play with. And it feels like sitting in Sweden is just wasting our time in a way. So, but of course, it's not driving revenue straight away, right? Because now we're integrating, you know, starting the expansion, go to market. So it's not adding to that monetization proof point, but we are entering US with a big partner, which is a huge traction proof point.
Yeah.
So I feel like either I'm not pitching to the right VCs, either we are too small in monetization, but also I feel like not many VCs, at least in Sweden, understand the kind of potential of creator economy. There are not that many experts on that subject. So am I kind of barking up the wrong tree, or the issue is with us?
Yeah. So a few comments, and I think some of it we'll also touch on later. But I think, okay, there was a recording thing here. Or maybe it was just me. But I mean, there are 2 ways of thinking about it. If people say it's too early, it might be that it genuinely is, because like VC is a good capital tool for running fast and growing fast. It's not a very good tool for most VCs. I mean, there are pre-seed VCs, but most VCs are not a good tool for iterations to hit product market fit. So the question is, where are you on the journey there, and what VCs are you talking to? I think is a relevant question. So it might be that you either should be talking to angels or clearer pre-seed VCs than where you are. That said, the other side of that coin is if where you are is just a fact, right? You can do very little about that, but typically if you say like it's the totality in your TTT story, right? If like it's obvious that it's solving the problem super well and the opportunity is big and that you are the founder problem fit, then that might make people take that jump anyway, even if the traction or sort of the stage is not there, right? So I think the question is sort of like how it could be that it's possible to build a narrative that that kind of solves it even at the stage you are, right? And the third is like the fit of understanding, and the more you understand about something, you're willing to take some risk and not other risk. Whereas if you don't understand something, then you don't jump in because you don't really know what risk you're taking at all.
Yeah.
So I think that could be part of the total equation here as well. And you know, now I'm once again answering from like a very generic point of view rather than a specific point of view, and I might also not be an expert in what you do, in which case I can also be ignored. But at least trying to think about how to address it or what are the issues.
No, but it's good to bounce it off you and get a unbiased opinion.
Yeah. Okay, good. Thank you, both of you. Shall we jump to I did answer up at least one of the questions in the chat here, and then we'll deal with the rest on the way as well. For some reason, my background here. Yes, so talking about process here. So I have a few slides on that, and I think we can make more comments around it based on the questions we had on the whiteboard as well. But this is once again like the top level slide about process, and I think it's worthwhile putting it sort of into the VC life cycle, and that's like, okay, it's about getting money in the bank account. That's why you're raising money. But it is part of a longer journey where you will work with your investor for years after that. And then ultimately the objective is to generate a lot of money at an exit. And just being aware of that and sort of understanding that investors will always have that frame. I think back in the day, investors were more sort of focused on the full value and maybe had very strong hypotheses about, you know, is this an IPO candidate or who can we sell the company to? I think investors are less focused on that today, but more focused on how can we build that thing that grows really fast and becomes really big. In that case, the exit thing takes care of itself, but it's still looked in the frame of not the process from raising the round, but from the process of the full journey from an investor perspective. Then, of course, in this conversation, we'll drill down into sort of the investment process part, not the full journey. That was just more of a framing. And if you see, I put 1 to 12 months here. And I can comment on that. So when I talk about the process, I'm talking about from first meeting till money in your bank account. And that's the frame I have for this. I think 1 month is exceptionally fast. 12 months is too long for an ideal process. I would say that what you need to prepare for is ideal, not I mean, good or target is 3 months, not 1 month. 1 month is like incredibly out of the ordinary. So target 3 months, I would say, and plan for 6. I think is kind of where I think the market is today. The 1 month is kind of an exception. Quite frankly, we were in a process this week where we met the company a week and a half ago. They had at least 4 term sheets in a week and a half, and they will probably have money in the account in a month. But this is the FOMO case. You have multiple term sheets in a very competitive in a very short period of time, and then the process from like the term sheet to get money in the account is more like less than a month if there is not a lot of issues, to be honest.
Arne, could I
Yes.
could I ask, while we're on this topic, can you tell us a little bit more about this company? Why was it so competitive? Why did they get so many term sheets and so quickly? Like, what was their ticket to success, so to say? What did they do so exceptionally well that we can learn from?
Yeah, I will try. It was not a deal that I pursued. It was one of my partners who pursued. My perspective is that it's an exceptional team, absolutely exceptional team.
Makes it exceptional.
They built it.
Give us a little bit
Yeah,
more.
so they are like serial entrepreneurs mixed with people from like very successful companies in like unicorn type of caliber companies. Secondarily, they built a product in a very short time and started generating lots of revenue. Is relative here. There's probably about 200K, but this is like in a month after launch, essentially, or maybe 2 months, and then it's a very big problem and a big TAM. So there's like, they tick all the boxes, even if it's early. They tick very firmly all the boxes initially, and they're probably well connected in addition to that, right? So this is kind of, there's like a deal like this in the Nordics a year, but there's not really all that many that run this speed. So they're probably, I don't know, 200 proper venture deals in the Nordics each year, and there's maybe 1 or 2 that goes like this. So more like, I would say, like the end-to-end process is more like a 3-month process. So and that's a reasonably good process. So so I can explain how I see a reasonably good process. And a reasonably good process is that for some reason you meet the company for a first meeting, and the first meeting is like a 45-minute to 1 hour meeting where you go through like the pitch deck, and it's a proper discussion about what the company does and the fit and so forth. And then it turns into multiple meetings. I'm not talking about an equity round, not a smaller convertible structure round, but it turns into multiple meetings. And so what VCs do, the first meeting is sort of like getting an overview of what this company is and how interesting is it, and blah blah blah. And then you start, after the meeting, you maybe you have the pitch deck before, maybe you have it after, and then you start thinking, okay, well, what do I really need to know whether this is something for us? Or you might already know that it's not for us, in which case you say, thank you so much, and you come up with some explanation that may or may not be true, depending on how I think we all should strive for being sort of transparent, but typically if we don't like the founder, we don't write that in an email, because that's just not good for anyone, right? So the transparency is somewhat between 10% and 100%, and probably on average like 65%, I would say, but varied a lot from company to company. But anyway, so let's say that this, like, you like it, but you typically try to drill down into what are the key issues I need to find out whether we should continue the process. because it's better to find out like what disqualifies early, because then you save bandwidth to pursue the things that you really should pursue, right? But typically, if like the initial sort of hotspots check out, then you deep dive and you sort of both deepen and broaden your understanding and build a relationship with the founders on the way. And ultimately, you get to a point where you think that this is something, and then you start trying to figure out if you're a fit. Like, are we aligned on missions, and does the valuation work out, and what are the expectations? So it becomes more and more concrete. And I think actually the alignment check is very important. It's sometimes skipped, particularly the competitive deals. It's skipped, and that's actually a bad thing for all. So I would say the sort of period of figuring out is typically a month to a month and a half. And then you get into a situation where you like start to nail down what does this look like, and negotiate. And that's maybe 2 weeks to a month. And then if that's successful, you end up with a signed term sheet. And with a signed term sheet, the intent is to make the investment. And then from the term sheet, you get into like formalities, and the formalities are two things. It's some form of due diligence, and it's some form of negotiating from term sheet to final agreements, which in the Nordics tend to be 2 agreements and then maybe some general assembly protocols, which are formalities. In the US, it's up to like 5 agreements that you need to negotiate. So that's why I'm saying like there's a month to a month and a half of like figuring out this thing. There's like a half a month to a month of negotiating, and then there's a month of getting the details right before you sign everything and the money is then the count. And that's why I'm saying a reasonably smooth process is 3 months, but typically smooth process means term sheet at month 2. And there are many reasons why the exploration phase takes longer than a month or a month and a half. Yes, Anastasia, you have a follow-up here. Yeah.
Yes.
Go for it.
I'm just curious to follow up on that 1 month or 1.5 months leading up to a term sheet. So if you're kind of an average Joe, so not your unicorn previous founder team, right, that gets 4 term sheets. If you're first-time founder, right? Can you just give us a little bit more color on what is happening in that 1 month after the initial meeting of introducing, and then you thinking, okay, what do I really need to know if this is for us? Like, what goes on? Like, what is the thought process there? What are the questions? Who's involved? Who's making decisions? How are the analysts and the partners dynamic? Like, I would love to deep dive on that 1 month before the term sheet, and what would you say is the number 1 key that we can do as founders to make sure that we get a term sheet?
Yeah, there are a lot of elements there, but so from a positive perspective, we try to validate the TTTs, right? Do we think this can be big? Do we think it can go fast? Or and do we think like you are the people, or you are the person, or whatever, to make this happen? That's kind of like, so anything that can substantiate that is like good. But there's also the sort of, how do we try to, but in reality, we also try to disqualify or sort of take out risks, right? What can go wrong here? Or why wouldn't it, even if the TAM is big, why wouldn't this company make it to this big? And that's kind of like, what are disqualifying factors? Oftentimes you like, some companies are in super crowded spaces, right? Okay, so is it truly differentiated? Who are the competitors? So that's typically could be some sort of drill down thing that you really get into. So the drill down is individual, right? It's kind of like, for me, it's I think if you're a new analyst, then you go through the whole checklist and you kind of try to boil the ocean. If you've been a VC for 15 years, you sort of have a pattern matching. If this kind of company, this is the thing I look for, or these are the metrics I'm looking at. Like, so your consumer case, what's the retention graph? That would be like the first thing you'd look for in like a consumer internet case. Whereas for a different one, it might be competition or whatever. It's the flavor of the partner, what he perceives as the main risk for derailing this type of thing.
Well, what then takes a month, right? Because this kind of questions, you ask yourself, okay, what are the main risks? What is the retention? What do we need to know? It feels like what is happening during a month is what I would like.
Yeah, but you have to think that I take me as an example. I'm looking after now 10 companies that I already invested in. I have board meetings. I had the founders calling me. We're raising money for that. That my existing portfolio is 40% of my time. And then I have reporting duties for this and that, and external board meetings and things. 20% of my time is overhead, so there's 40% of my time doing new deals. And I'm maybe looking at 10 companies now, so that's 4% of my time. And then if it's really exciting, maybe I can turn the 4% into 10% of my time to pursue something. But it's very, very rare that I'm spending like my full bandwidth on initial meetings. Right? I might do that in the closing stages of this because it's super important. But the exploratory phase is never, unless there's this competitive pressure on me that I need to make a decision tomorrow, otherwise some other VC is going to steal my lunch. And that's why the FOMO is very powerful. Unless you are on 4 to 10% of my time trying to figure this thing out, right? That's the reality. And then there are you talk about the analyst and the partners and so forth. Some firms have a lot of analysts, but in reality, analysts can just do donkey work. They don't make decisions. So even they are subject to whatever internal timeframes are on other processes and whatnot. So they can do more work, but they don't actually. They do speed up a little bit, but it's not like speeding up relative to the amount of hours they spend on something. And the dynamic of the decision making is that a partner leads the deal, and that's the person who needs to run the process and be in charge of the process. And some point before the term sheet, you typically, depends on the firm. Some have like where partners can do initial investments under a threshold, or have big leeways and go to the partner meeting and get authority to do something. But in most cases, it needs to fit in to a Monday slot at the late stages, and you meet the partnership for 30 minutes, and the partner who's leading the deal says, I want to do this. Now look at these brilliant founders. I want to back them. And then you have to present, and hopefully the other partners think that you're as brilliant as the partner who's leading the deal. But ultimately you have to have that champion to run it through, because without the champion, nothing happens essentially.
Exactly. Arne, can I also, one more question, sorry, double clicking. So first of all, my takeaway from is build a relationship with a partner. Like if you want a decision, you need to build a relationship with the partner. And then my second question is, of course, I want to make sure I do as much as I can to help you reach that decision, so you don't procrastinate and leave it till last moment and then you lose interest. But how do I strike a good balance between being a little bit relentless and helping you to make the decision versus annoying you of like following up and being like, okay, Arne, what's happening this week? So how to do it in a proper way? What do you see works? Like if you think about yourself, right, and the founders, what helped you to speed up your decision process and how they've done it well so it didn't annoy you?
Yeah, so first question, do you need to build a relationship with a partner? I think so. Actually, in our firm, and we might not be right, but the way that we've done it is that we've decided that we only have one analyst. That analyst is allowed to be in meetings and will go to meetings and help us do the work, but we don't take meetings with founders unless there's a partner at the table. And the simple reason is that we have realized that there's a lot of founders who don't like meeting analysts because ultimately they don't make any decisions. So this filtering in, analyst, associate, and then to partner, and the partner says, well, the analysts don't know what he's talking about, so you wasted a lot of time. We don't like that. And therefore we've decided that in all meetings with companies, there should be a partner, otherwise there's no meeting.
Yeah.
But that's not how the industry generally works. So that's that part. How do you speed up? I think there's a limit to what you can do in speeding up, because you unless there's competitive pressure, and to me, if it's burning in one of our portfolio companies, that is more important than doing a new deal. To be frank. So like if you tried to push me to like not look after my portfolio companies, then I'm gonna think, well, she doesn't know what, how this works, and that's just annoying, right? So I think there's a limit. Of course, the better you can answer all questions, and the better smooth the process is, you can maybe save steps, but you can't fundamentally change the time slots unless there's competitive pressure, which means that you need to reprioritize.
Yeah. So okay. So FOMO is basically the strongest lever we have to.
It is. It is. Yes. Christopher also had.
Yeah, so I just wanted to get your take a little bit more on the valuation exercise here. So like, how do we kind of go about presenting a valuation at what time? Or is it more like, I don't know, some more like informal discussion with VC, what they see as the valuation of a company and what they see as fair? Or like, how does that number come about in the talks?
Yeah. So our process is the valuation exercise that I, talked about before. But I think in the first meeting, I am likely to ask you, well, so last time you raised, what did you raise and at what valuation rate? If I don't ask that question, I'm not interested, by the way. And so that's like maybe a good takeaway. And then I will ask, so what are your expectations now? And I actually expect you to say, we're in the market and the market will decide. And if you say valuation, that also means that you probably don't know what you're doing. To be a little bit, it's not quite as, if you already have indications or, from others or something, or you give like a loose range or something. But my general advice is don't present, answer what you last raised at, because if you don't, then you're hiding something, and I'm going to find out anyway. But on valuation this time, don't answer the question, and do it in a smooth way. But everybody. Yeah, so I guess we can get back to, and now we're talking to something that's on the whiteboard, and it's partially process and partially company and cap table. So cap table is a very important, a fundable cap table is a very important quality of a company. And fundable cap table, we did mention it in the evaluation exercise, is that the founders own enough to be incentivized at the right stage, appropriately at every stage of a company's fundraising journey. And if you look at fundraising history, the dilution per round of equity has historically been between 20 and 30%. Over the last 5 to 10 years, it's more been 20 to 25% than 20 to 30%, and the ideal dilution in a round is 20%. So if you come to me and I say, you say you're raising $2 million, and I think it's a good company, and I think you know what you're doing, my calculator says that the pre-money of this default is $8 million implicitly, because that's 20% dilution on, 10 post and 2 money in, right? And so if you don't answer, that's my assumption. And this is how all experienced VCs think about it.
Cool.
So what you ask, so this is a kind of a triangulation, that what you ask for should be reasonably aligned with with 20% dilution, and it should also be aligned with 18 months of runway to achieve your execution plan needs to, with the money you ask for, give you 18 months and reasonable milestones for an up round based on this. So this is also a triangulation for what's fundable, to be honest.
Yeah. Makes sense. So if I answer that, like, we'll see, the market will decide, then we'll both know back in our heads that that's the calculation we both are making. But will it actually be kind of like in the negotiations that you guys will suggest something as what you're willing to invest on what valuation, or is that a proposition from you guys then?
So at the term sheet stage, typically investors propose a term sheet.
Yeah,
that's typically where the suggestion of price comes. And you don't have to take that, you don't have to sign the term sheet, but that's typically the way it works.
Yeah. And if you get different valuation from different firms, and you kind of need both of them to hit the money you're asking for, and how would that work out then?
Well, if you have 2 term sheets, by default it's kind of, and we'll get back to term sheets because it's not only valuation, there are other terms in a term sheet as well. But in theory, if they're all equally valuable as people on your board and as investors in terms of what they do except from the money, if they equal there and the terms otherwise is equal, the rational thing is to choose the higher price, right? Or the least dilution or whatever. Then again, there are situations where, we all investors like to think that we add value beyond the money. And some people do and some people don't. And some investors are actually pretty destructive to have on board, even if they pay a lot of things. So I think there is difference between investors beyond the money as well. We, as an industry, tend to overstate our value, to be frank. And the ones who add the ones who add the least value and cause the most havoc are typically the ones who overestimate their own value the most as well. But in theory, like, so say you think, oh, Arne, I'd really like to have Arne on my board because, I've talked to him during TINC and he seems like reasonably sensible. And then somebody else comes with a higher term sheet, and you say, I don't really know if I like them or how good they are, but that Arne dude, he seems to make some sense. Then you should go back and say, like, look, I have somebody who's willing to up it. Where are you? And that's a good competitive dynamic, right?
Yeah. At least for now, I can see you got an edge, Arne. So you gotta get an edge.
Okay. Let's hope so. Sometimes it works, sometimes it doesn't.
But I was also thinking about the case where, like, how often do one firm put up all the money you're asking for? Like, if you're asking for 2 million, I guess it's typically that there's co-investing among the different VCs to hit 2 million. You put up half the money. So kind of like, if you have different term sheet, different valuation, like, is there a kind of alignment process going on that stage?
Yeah, we'll get back to that.
Okay, sorry.
Yeah. So just in terms of the process here, right? It looks like a very sort of a few things about term sheets, right? Term sheets can be 1 page or they can be 10 pages. And in some ways it seems very easy, like simple to have a 1-page term sheet, but then there are a lot of details left out for the final agreements to fill in the gaps. And generally what happens at term sheet, then you hire lawyers and all sorts of things, and money starts running. And typically your position, the deal never gets better than the term sheet from your perspective. So if they're like big open things that are unresolved, the term sheet, a lot of investors are reasonably fair and it's reasonably standard, but you're not really sure. So sometimes it's actually better to spend slightly longer time on the term sheet before you're locked into exclusivity and the clock of a lawyer starting ticking that you're paying for, and then finding out that, oh, there was these things we haven't negotiated. So I would actually urge you to sign a good term sheet, whatever length it is, that it covers all the major things. The other is to understand investors' term sheet habits. Good VCs don't walk away from term sheets because good VCs, it's also reputational damage. You should mean it when you sign a term sheet, but of course, if you find out that there's fraud in the company, or it had a $20 million debt that nobody told you about or something, it's fair to renegotiate or walk away. But you shouldn't lighthearted walk away as an investor from a term sheet. You should see it as even if it's not legally binding, it's sort of if things checks out, it's sort of ethically binding. But that doesn't mean that all investors behave that way. Some investors who come from other asset classes, they think of, it's not legally binding, and therefore it's kind of an option to invest and keep, considering that after the term sheet. So I think that's why I made sort of this is the traditional view of a process. But I actually think that the informal part before you sign a term sheet is actually informal due diligence, whereas the stuff after the term sheet is the formal due diligence. And so I think you should think of it as due diligence in both sections, and we should. And before we sign a term sheet, we should actually be pretty certain that we want to make the investment if things are the way that they are. And so we should check what we need to know before we sign a term sheet. And most of this is about the fundamentals of the business and the people and this sort of thing. So we should be pretty certain before term sheet. And then the formal due diligence after the term sheet is much more about checking the agreements don't have holes, and are the accounts what they've been presented to be, and so this is much more the legal and financial thing. And good VCs do it this way, and it doesn't really cost any money because the VCs do the work pre-term sheet. The stuff that costs money is the the lawyers and the things after the term sheet is signed. Yes, Anastasia, yeah.
I'm your favorite student today. So just out of curiosity, actually, because in my extended friends group, I actually have quite a few number of founders that the VC pulled out after the term sheet. So just out of curiosity, I wanted to ask the reverse. Do you see that it's actually common or normal practice that a founder kind of accepts 2 term sheets and goes through the DD process with 2 VCs, let's say, in case one falls through for whatever reason, that they have the other one? Is that kind of common? Is that something you would actually advise us as founders? So if you were not sitting in a VC chair to do, or is it no, that should be super unlucky that you get a term sheet canceled? In reality, would you advise us to go through with both VCs if we have 2 term sheets?
Absolutely not.
Okay.
I have not seen it. Ever. And I would be majorly pissed off if that happened to me. And I actually think that is a reason to pull out, because it's fundamentally unethical the other way. So I would not advise it. It's very bad practice, just like it's bad practice to pull out. I mean, there are legitimate reasons to pull out of term sheets. Most of it is that misrepresentations of the company, not that you haven't done your work. But I mean, there are sort of external factors as well. So say that I think are legitimate. Say we were close in 2022 because we had a term sheet out for a company that had extensive development teams both in Russia and in Ukraine. We had signed a term sheet, and suddenly sanctions come in, and so a lot of the business is actually illegal, right? under European law. We actually went through with the term sheet and just made sure the company complied with European law. But that is a situation that's kind of like fundamentally out of your control, and it puts the company in huge risk situation. And I think actually in hindsight, I think I've been thinking about it multiple times, and I think it was actually legitimate reasons for pulling out of the term sheet, because it's circumstances beyond your control that fundamentally changes the situation of the company. But in this case, we did not do that. And, who knows whether this is the one where we made 10x or the one we lose all our money, but that's still in the game, right? But so I think there are sort of, if you invest in something to have a factory and suddenly the factory burns up, right? Do you still go through with the term sheet? I don't think you do. But it has to be pretty serious sort of new developments, unless it's misrepresentation, I think. And signing 2 term sheets is misrepresentation, because there are exclusivity clauses in there.
No, fair enough. Good point. Good point. Good to know. Good to learn.
Yes, Christopher.
Yeah, on that, so like, how can we figure out the reputation of a VC in doing that? Can you ask them blunt, like, do they have any cases that this was the case, or is there other ways to get that knowledge?
Yeah, I think, part of it is like, how do you see the term sheet? What does it mean to you? Have you pulled out of term sheets? Ask founders who worked with them so we do reference checks on founders. You should do reference checks on us as investors. We should give you 2 portfolio companies to talk to. And if you know some portfolio companies that we don't give as a reference, you should talk to them. I think that's natural, and if investors don't like that, that's probably a reason for it.
Yeah.
Yes, Anastasia.
If someone else has a question, please go ahead. But I have another question, maybe a little bit conjoined, but a little bit different. But I don't want to take all the space.
Go for it.
How do we figure out, any tips from a VC perspective, how do we figure out which founders are successful and are kind of in favor or in good favor with a VC versus founders that VC already wrote off in a way? And why I'm asking is because I think one of the games to get the term sheet, or not games, but one of the more pragmatic ways to get a term sheet is to get a warm introduction from the founder within that VC, right, within the portfolio. But then there is a difference between founders who are, liked versus maybe founders who are not performing so well and are not so liked by the VC partners. How do you figure out, like, is there subtle things we can see on LinkedIn or somewhere? Like, what are the indicators? Because we also want to talk to the right founders that will, when you get an introduction from them to meet us, you'll be extremely excited about doing that.
Yeah. So I think there are actually founders who don't succeed that we quite like, because it was the right gamble and they did it in the right way. So I don't think necessarily a founder failing is a detriment. But of course, VCs always like successful founders better. But the way to look at it is essentially, have they raised up rounds? That's an indicator of success. In Norway and the Nordics and Sweden, it's very easy to see whether companies grow because the accounts are public. Growth is an indicator of success. You can see if the teams grows from LinkedIn, that's an indicator of success. It's pretty easy to figure out who's successful. And if a company is not profitable and it hasn't raised money in 24 or 36 months, it's probably not very successful.
Fair enough.
But one of the things, we don't go and out founders, and we don't. It's bad for so even if we have a portfolio company that's not performing, we tend to speak well of them, even in the scenario where we don't like them. And the reason for that is there's just reputationally damage to talk bad about people. And the second thing is in our interest to, even if we don't believe that they concede, even if there's like 1 in a million chance they will do, that's good for us, right? And if we talk bad about them, the risk, the likelihood of the 1 in a million to come through, it just goes away, right? So we tend to speak nicer of people than we mean, out of pure self-interest. Okay, sort of back to So on process and discussion points. Also, I don't know where to put the cap table issue, because we've been touching on it and sort of dilution. I think the way to think about it is that the gold standard is 20% or less dilution per round, and essentially what you need to aim for is, and the gold standard is actually that founders go past Series A. So Series A is typically the investment at, I don't know, $10 million at $40 million. When you pass $1 million of ARR, that's like the typical thing. You want ideally founders to own 50% of the company after that. That is still reasonably rare, but you need to have at least 50% by the time you get to that. Otherwise, it's kind of not the typical venture cap table. So I think that that's how to think about it. And the further away, the harder it gets, and particularly in the US. There are less experienced VCs in the Nordics who don't think so much about this, but they are also the one who are bad at helping you risk mitigate your company, because then they don't really know how the market works. On process, so this finding a lead investor. So this relates to the question from Christopher before about, like, so say you have two that have a term sheet. So the point is that there are roles in investing. One is being a lead investor and one is being a co-investor. So the lead investor is the person, the investor who negotiates the term sheets and runs the process, and may or may not do the full round. Oftentimes not the full round, because the round typically, existing investors might put in money, or like a new co-investor or something might put in the money. But typically the lead investor does half the round or more, is typically the scenario. And these, until you have a lead investor, the person who will negotiate, or the investor who will negotiate the term sheet and run the process, you don't actually have a round. So and then there's like weaker investors out there, or an answer is often, we can't lead this round, and that's typically, it might be that it's truly too big, and then if you look at an investor's history, and this is a much bigger round than they typically invest in, they might be telling you the truth. If they typically do these kinds of rounds often, then they're lying, and unless they give you a very specific reason. And that means this is kind of like a no, but I'm hoping that something really good happens and a fantastic lead investor comes and I'm invited to be a co-investor. So be suspicious of people who say I can't lead, or so that's also a question for you in the first meeting. Do you lead rounds? What kind of rounds do you lead? And then once you have a signed term sheet with a lead investor, typically it's easier to find others to plug into the round. But you need at least a lead or two firms doing co-lead of a round to make a round happen. So understanding the dynamic of being a lead investor is and the role is very important. NDAs is typically, don't ask for NDAs in the first meeting. That's like a big red light telling VCs that you don't know the game, because VCs don't sign NDAs, or they may sort of after 3 or 4 meetings, if they need to dive into like some IP thing, or like they want to see as the process the full pipeline of customers, and that's sensitive or something like that. So late in the stage or at term sheet, term sheet typically has confidentiality clauses in there, but no VC signs an NDA for the first meeting or the second meeting. And if you ask for it, it's sort of an automatic no, or an automatic disqualifier. value of introductions from trusted sources. This is a little bit what Anastasia talked about, right? So there are VCs that don't do investments if they're not referred. I think that's not the general rule, and it's less usual in the Nordics. But say if you, so let's talk about the sort of the numbers game. So in reality, so we look at more than 1,000 deals per year, and we do ideally between 5 and 10 new investments per year. Last year it was actually below 5. It was 4. But the year before we did 8, and we aim to be between 5 and 10 per year of new investments. But we look at 1,000 deals, so that's like 0.5 to 1% of deals we invest in, and this is a very typical ratio. So that means a few things. One, you shouldn't be talking to only one investor, yeah, and also that means that we look at a lot of good investments that we don't do simply because we have to prioritize. If we just do too many, we don't have the bandwidth, and we don't have the, we burn up the fund too quickly. So it's just it's pretty obvious the 50% that we're not doing, and we don't do meetings with them. And I think like we're down to about 20% of the deal flow. We probably meet about 30 to 40% of the deals, but from the 30 to 40% to less than 1%, that's a lot of fall off, right? And that's why there's this sort of processing of trying to like disqualify things quickly if we're not going to do it in the end anyway, just to save bandwidth. And then once you get into the top 5%, it can be a lot of coincidences what we choose, because all of them are good investments in theory. But the thing is that by having good introductions, you probably go from like 100% down to the 20% automatic, right? So it just improves your chances, but it gives no guarantee, but it just puts you higher in the priority of processing. Yeah. Then I think it relates to the process is about fit and positioning, and that is finding out. There are a lot of there are funds in the market who are run out, or the fund is empty. They're doing such geography, such strategy, such stage, and typically sort of communicating with many with an imprecise pitch just doesn't work. And I think it's much better to like you go to 1/10 of the firms you try to communicate with, and just make sure that they do what the type of company you are, and explaining why you're a fit for that investor. So I would go much more targeted is much better than broad, in my opinion. Then there's the partners versus firm dynamic. We sort of talked about that slightly before, but it's not a firm that makes an investment. It's a partner that makes an investment on behalf of the firm, and you need to find somebody who's willing to be the champion and run the process through the firm, because without that champion, the deal never happens. That's the person who sort of brings it to the partnership and says, I want to do this. And therefore, in terms of like doing the research, I think it's also worthwhile figuring out who are the partners in a certain firm that are most likely to like what you do and get in front of that partner. Then it's the sort of there was a question about relationship building, about how to run the process, how do we make it competitive, how do we run it from end to end. I think that relates to the ask for advice and the time and thing, and also the question, should we only talk to people when we're racing? I think this is sort of very spread field on what the advice is. I'll tell you what I like, but people like different things. So there's no answer for all. I like to meet founders early. I like to build relationships because it helps me understand if I'm compatible sort of from an alignment and chemistry perspective with founders and the journey. And it also helps me figuring out if they are good executors. So I like and if you were to research the latest investments I've made, it's people I've known for years. And that's probably it. it's good for me because it's de-risking for me. You can of course then go and say you have no risk tolerance, right? You shouldn't be like that, and I also accept that, and I'm sure I have done investments before in people I didn't know, and I will do again. But I like the relationship and figuring it out. There are US firms, for example, and there are founders in the US who say, you need to run a hotly contested process. Don't let anyone in before, and when you go out hard, and you talk to many, and you make it competitive. And I respect that point of view, but I think it depends a lot on what you have. Are you one of these that can create FOMO and know how to create FOMO, and it's a no-brainer that you get it? Run a competitive process. I think most people will not succeed in that, to be honest. So I think it's worthwhile trying to figure out where you fit, and unless you're one of these serial founders, I think the likelihood of succeeding with like a process over time is higher than like a competitive give me term sheets now or we're not talking again kind of things. All right, we have another question. Go for it. Yeah.
I would love to deep dive on this relationship building topic. How do we build a relationship with you, Arne? Tell us more. How do successful founders that you really like and invested in build a relationship with you? Take us through the entire journey, step by step. Give us a little bit more to work with.
Yeah, so there's no like one formula that works, but you have to be able to find a way to talk to us, right? So now you're thinkers, right? So now you can, send me an email and say, I listened to this or that session. I'd like to pick your brain on something or other. That will generally lead to conversation. That that works for me. It might not work for the next one or whatever, but you need to find, is it a pitch event? And you asked a good question. I'd like to get your feedback or something. You need to find some way of talking to people, and you need to get to a short meeting, right? And you need to be relevant in that meeting, and you need to sort of have something interesting to talk to. And people in this industry are curious, and they like good founders, right? So it's about getting through the door somehow and having quality conversations. And the more quality conversations you have, the more likely you are going to have a follow-on quality conversation. And that's how relationships are built, right? I think what you do is interesting. Therefore, I'm willing to continue. And it benefits me to continue this conversation, is essentially how it works.
And is this quality conversation about basically the topic that we are thought leaders in and we're building a startup, or is it something generic like, oh, let's talk about AI or whatever? Or is it
it tends to be specific.
Specific to our startup. Let me tell you about how social commerce works, kind of, and get you excited about it.
Yeah. Yeah.
Mm-hmm.
Or things that, or say like, I'm on this stage of it. I realize that you only, you typically, I don't know. I've seen that you sometimes do pre-seed rounds, but I've seen what most of you do is like, most of your deals are seed rounds. I'm at this stage. What are you looking for at that stage? I would like your input so I can come back. And so when I have what you need and I'm fundraising, I know when to come like pitch. So it can be a range of topics, but they're generally directly relevant to the setting, to what you do and what I do. Of course, if you can tell me the insight of AI that makes me make better investments, even if it has nothing to do with what you do, great, I'll have that conversation too. But that's just an much more unlikely great conversation, right?
Yeah. And what happens after?
But founders are curious and smart. VCs like to think they're smart, but at least they're curious and they have things they're interested in. And if you can like tick the boxes of interest and curiosity, then you have good conversations.
And can I ask what happens usually after? So we had an amazing conversation, right? I saw your pitch, whatever event. I followed up. We had an interesting discussion. How often and let's say I'm fundraising in 6 months or 12 months. how often do I keep engaging you, and how does that typically look like? Because you probably don't want to just jump on a call and talk more about my social commerce.
You don't want to talk weekly and monthly. You might want to talk quarterly or half yearly, or you can ask, what kind of investor are you? Do you like to build relationships, or do you like to see it when we're racing? Some people are different. If you like to follow the right, what's your preference? Do you want to be on our investor update list? Do we talk every 4 months? Is this interesting? Just ask people what they want and then survey accordingly, but try to, the better quality you have to deliver each time, the more likely it is, right?
Fair enough. Can I ask, does this also work with female founders? Like, how many female founders do you have a relationship with? Just a data point, right? Just out of curiosity.
I don't know the exact answer. It's in the tens, not in the hundreds. So
But
probably approximately proportional to the number of female founders there are in the ecosystem.
But is there anything you see that the guys are doing better that you would give advice, for example, to me in this case, or other female founders, that we can do more of?
I don't know. I think I don't know. It's a hard question. I think female founders are better at delivering than male founders, but they're typically presenting less confident. So you know how you always discount founders, but if you discount female founders compared to what they say, then they don't look impressive. So you probably should discount female founders less, or female founders should present with the confidence of mediocre male founders. As what was it? It was on one of the pitch panels for Reach, also that what's her name said that female founders need to learn how to pitch like a mediocre middle-aged man from Middle America.
Christy.
and I think it's probably an oversimplification, but and I think there are distributions for all. I have a term sheet out with a male founder, and he's super softly spoken, but he's just very smart. So I think we should just work with biases and try to get to like the core of everything, regardless of what color or gender or whatever people are, right?
Just a small task then. Right.
Yeah, but it's
good stuff.
I don't know. Yeah, and then the other thing is like deliver on plans. Getting back to my list here is that like if you come and tell me, even if you're pre-racing, right? Maybe I'll come back and I'm racing maybe in the fall, and if you tell me like where you're planning to be in the fall, and then when you come back in the fall and you're like have made no progress, and just where you were in the spring, and you're super short of your targets, right? Then you have undermined your credibility as a founder, regardless of. And the same thing when if you realize that the fundraising period is like 3 up to 6 months, and then you have milestones in that period, and particularly before the term sheet, and you just fall massively short. Like next month I'm landing 4 big deals and there's none. That's a problem, right? So I'm not saying sandbagging, but just be realistic what you can achieve within because it does count against you in the fundraising timeframe if you sort of massively underperform. Okay. This is.
Are you on time, Arne? Are you going to be okay on time? Do you think?
Okay.
Yeah. Well, someone probably doing. Yeah, but.
Yeah. the equity round terms, this is what's in the term sheet, right? There's some various terms in there. I'll do it very quickly. These are the list here are the things that I would care about. Most people care about valuation, and it's the only thing they care about. It is the most important term, but don't forget the other ones, because that could lead to disaster. So preference structure is typically a very important one. US is what's called 1x non-participating. So be aware of that. Everybody expects, investors check whether you're incentivizing your team and are willing to take a hit by recruiting really good people, and really good people want to have incentives. So if you're not willing to share option pool, that's sort of a flag that you're not in it for building value or don't understand how that works. Board composition is typically something that is a tough negotiation, or it's not a tough negotiation, but it's important. Nordic founders tend to fill their boards too early. Too big boards. Good VCs want founders to drive the companies, but they still want a board seat. So the right sizing of the board and who gets the board seat is an important vesting. We invest in you. That means that we expect you to be there for the long haul. And the way to show that is that you are willing to have your shares vested over that period. If you resist that, that's a signal. You know, in essence, we're buying lottery tickets when we do early stage investing. And the way that we want, if it's a winning ticket, we want to put more money in, and we want pro rata rights. So that we're going to require that. And if there's pushback on that, then that's a signal. Protective provisions is a balancing. We don't want to run your company, and we don't want terms in there, but some do, that makes you a slave of the investor. So the protective provisions, you should defend yourself against bad protective provisions, but it is fair that there are some. So it's, we don't want you to sell the IP of the company for 1 kroner or $1 to your friend. That the company should be protected from. You should not spend the money on buying a company Ferrari. That is fair that the investor says that's not what the money was meant for. These sorts of protective provisions are completely fair, but they should not hinder you from running the company. And then, as I said, the company is for sale at some point, so there is typically a drag-along provision in here. And so these are the things to be aware of. Some of them are like flags, some of them are just reasonable discussions. Yes, question.
Quick one. At the seed stage, is it common that the investors demand that you vest from zero? So if you already had, let's say, a shareholder agreement or, a first round, pre-seed round, and it's been 18 months, so you vested something, let's say, I don't know, 5%. Is it common that it gets annulled in a way, or you keep your 5% and then maybe there is new vesting conditions, or you really start from zero again? What is the most common practice?
I'd say the most common practice is to accept some vesting. At seed, I would say having 3 years of it's typically a four-year vesting schedule. Having 3 years left of vesting at seed is completely reasonable, I think. But having vested 1 year is maybe, I think, is a good standard. Not zero vesting is not, in my mind, reasonable.
So not zero, you start from 1 or something like that, yeah. Great.
Yeah, so I'm doing, the term sheet I have out now, it's 3 years vesting, 1 pre-vested.
That sounds great, thank you. And
then there are things that I think are sort of, if these things are in there, you should run away. That is people who want to have more than 1x preference. If they want participating pro rata is that they want their money back first, and then they want a pro rata share of what's after. Predatory pricing is where they essentially destroys the cap table. Full ratchet anti-dilution is if there's a future round that's lower, the current round gets fully repriced. In the US, something called broad-based weight average anti-dilution is the standard. Full ratchet is a sign of a shark. Super pro rata is sort of, I invest 10% in your company now, but I want to have the right to invest 40% of all future rounds. That's like the risk, the balance between the upside and the risk you took is just not there. You should not accept anything. You have to accept pro rata, but you should not accept super pro rata. And then the option vesting is kind of like a variant of the super pro rata. Okay, I invest 1 million in your company now, but I want to have a call option to put in 10 million in the future, right? Risk reward is just outsized to the favor of investors. All of these things push back hard and question yourself whether this is a good investor at all if any of these shows up. A lot of investments in seed and pre-seed are now done on convertible instruments. They're actually lower cost, and there are actually some benefits to them in that you can probably get away with better incentives for new employees as long as you keep it non-priced. And in effect, they're oftentimes priced anyway. It's just cheaper, priced by the cap. So it's just cheaper to do a convertible structure if you can get away with it. There are upsides and downsides to it. In the US, actually, I think 80% of seed rounds are now on a safe, which is Y Combinator's structure. So in the convertible instruments, essentially, this converts into next equity and at the later stage when the company gets priced. But for now, it's floating. But then the cap is the max price, so de facto it is priced. So typically, what you only have to negotiate the cap and the discount. So discount is the discount on the next round if it's below the cap or if there's no cap, and the cap is the max price that you convert on in the next round. And typically, the objective is to get much higher than the cap in the next round. If it's a convertible debt, there might be interest in there as well. Typically, investors do not get board positions, which may or may not be okay. I think it's early, it's fine. Good investors will ask for pro rata, some as if converted basis. So prepared for that. There's a standard side letter for a safe that does that. So if people don't ask for that, that's probably because they're inexperienced. So in the US, there's a convertible note, but now the safe is the standard more or less. In Sweden, there's something called WISE, and in Norway, there's something called SLIP, which is kind of like a local version of the safe, even if it's not identical. So I think that convertible instruments could be good. I think that standards are great. Standards are great because it's asymmetric. I invest, I negotiate investments all the time. You do it much less. So I should know my job better than you. And therefore I'm in a position to, trick you in theory, although it's probably shooting yourself in the foot, but there are people who try that. The way to avoid that is by going through standardization, because these are tried and tested and, they're reasonably fair. That's the one idea. And the second idea is that it takes down legal costs of doing it. And it's more about choosing the right standard for the right company and based on the trajectory of the company. So here's a link to a bunch of templates that I think are good practice in the various markets. And even if it's not standard, it's good to have them because you can compare the term sheet you get with what's in the standard. So I think that's that brilliant. And then, I got 2 minutes over time, and I don't know if I checked out and I blame Anastasia because she asked so many questions. Yes. But it's good with questions. But I'll still blame somebody since I didn't make it on time. Let's see. Those who have to jump off. And if you're tired of me, feel free to jump off as well. But let's just check that and see.
I'm gonna have to jump off because I have a board meeting. I guess they wanted to use the Zoom link, but they're finding a different link. But so sorry that I have to jump off, Arne, but we have a board meeting starting right now. But I'll put a little bit in the chat, and Nelly will continue. Yeah. Thank you.
I think so now, or process, I think we dealt with how to run process. I think we've at least discussed a bunch of things. Timing or signal. So I think that to run FOMO, just to be clear on that, I think FOMO is fantastic, but it's very dangerous to overcook FOMO because you might also drive people away or they call your bluff. So I think the way to do it is to actually talk to people and figure out where you are. And if you can create FOMO, do it and run a hard process, but otherwise try to build relationships and get sort of more an organic deal together, I think is the best I can come up with, to be honest. I think if you have a FOMO factor. Otherwise, if you don't know it, you don't have it. To be quite blunt about it. I think we talked about process, due diligence at seed stage. It should be rather simple. As a formal due diligence should be sort of confirmatory, legal, and financial. I think bad investors run too much DD. And I think the trend is that there's less and less DD, and good investors know that, because the risk is not the legal documents and the financial documents. It's the risk is, can you execute it? Can we help you do it? But bad investors tend to beat the fish to death. Presidential election, I don't think it has an impact. But I might be wrong. I think the presidential election have impact in mature markets. I don't think it has impact in pre-seed and seed, is my opinion. And I don't know. What's needed for seed, we talked about. Is there anyone who think I have not answered their questions properly? Or have a different one? Okay. Oh, we have one.
Why not, right? I mean, I already
Yeah, go for it.
No, but my question is then, if we can't, I got regarding the process, right? How to optimize kind of when you start the fundraising round and close it as efficiently as possible. So if I understood you right, basically it's all about the volume game, or either relationship and you have really warmed up connections, or it's just a volume game of just pressing start on as many VCs as possible, and then, you know, letting them proceed second stage, third stage, you know, take their time, and some will drop off, but some might stay. Is that basically what it comes down to then? Then it's a volume game, unless you have relationships, or
I think it's
is it a volume game just to press start on as many VCs as possible?
No, it's a mid-volume game. So the odds is you need, you know, 20 or somewhere between 10 and 50. But there are 7,000 VCs in America. And so, like, calling people who are on the wrong strategy and wrong stage and this sort of thing, and I think it's a mid-volume game with quality, to be honest. And then it's about maximizing those likelihoods. So I think like the, you know, can you get warm intros? That increases the likelihood for each of them. Good and targeted communication, good process. All of these things maximizes each of the likelihood, and it's a sum of that mid-volume game that sort of makes it in the end. But there are many other tricks in sort of figuring out who to go after, right? So I think it's sort of also a research game. Okay, who has invested in this sort of thing before? Use Crunchbase, right? In the right kind, like who's invested in this space in something that's already a success. Okay, who did this? What's the company in my space that was successful and it's a unicorn or whatever? Who invested in that seed round? Who was the partner who led that seed round? This is sort of information you can get out of Crunchbase. Who was the angels? Ask them for input. So the more the you know, how did Google win the search war? Quality and relevance, right? And I think this is also how you build this. You need to find the right partners in the right firms to understand this, the right angels. If you find the right angel, he knows which VC who does this. I actually think that if you can build with good angels in your syndicate, that will drive the right VCs in. And so there's a lot of domino, there's a lot of quality involved more than the volume, but you can't have one. You have to have mid-volume with qualities is kind of where I am with it. And the better sort of chain of dominoes and relevancy you can build, the more likely you are to succeed. And so I would say, so if you can, you know, whatever your space is, if you can talk to the 20 best angels in the US about this, and 3 of them decides I want to have a small ticket, the VCs will come.
I love it. This is actually the best advice. This is so relevant. Thank you.
Okay. Perfect.
Yeah. Good. Well, best of luck with it.
Yeah, thank you so much, Arne. Thank you for a great session. And we will also put this recording on a node for everyone. And if you want to rewatch it or
And I'll hit up Matthew separately on the CVC thing, because I think that's the one that I haven't checked out properly. But I know he asked it, and he's not here, so I'm not answering now.
yeah, sounds good. Okay, perfect. Thank you so much. And I also put some info in the chat for you guys if you have a time to just fill out the 1 minute, some info about your arrival info, and then also a little bit on who you want to meet with here and your target market and customer and so on. That will really help us to help you when you come here in 2 weeks. And yeah, make sure to book your one-on-one meeting.
Bye-bye, everyone.
Thank you, Arne. Thank you so much.
Thanks so much, Arne.
Thank you, Arne. Bye.
Yeah. Bye. And I know we're way over time now, so I'm gonna let you go. But do you have any questions at all before we leave today?
I think I maxed out my questions.
Yeah.
Sorry about that, guys. Sorry, but it's a super relevant topic, so I hope it was relevant for you.
It was good questions.
Yeah.
Yes.
Are you even racing or what?
Yeah, we're racing.
Thought so.
Okay, well, if you don't have any more questions for today, then I'm gonna let you go. I know it's getting late for you guys, so yeah, nice seeing you again. I'll see you tomorrow, hopefully, in the check-in call.
See you.
Perfect.
Peace.
Bye.
See you, everyone. Bye.
Bye.